Hi, we're CAT LLP with Catalino, Andrea, and Tam, here to make recommendations to XYZ Whole Distributor. We have recommendations on both the cash collections aspect and the cash disbursement aspect. So first off, to reduce our uncollectibles of 5%, we would need to have more focus on credit approval to have more reliable agents. We would also need to use accounts receivable agent report to determine what customers to make sales to and which customers are more reliable. We could also change this cash collection period to a shorter amount of days. For example, going from a 90-day expected collection period to a 60-day collection period. This would result in a 2% uncollectible amount. By doing this, income would increase from the decrease in sales discount and its increase in total cash collected. This way, XYZ distributor would be able to collect more of their sales. And on the cash disbursement side, distributions, we would need to look to manufacturers with lower prices and those that offer more discounts. Also, we could extend our time frame to make vendor payments from 60 days to 90 days. This would change their payment system by paying 50% of their purchases that month, the following month 30%, and the remaining 20% in the third month following. Thank you.
My name is Tan Tran. I would like to present the analysis of cash conversion cycle. The cash conversion cycle is the time it takes the company to convert its resource input into cash. The formula is the days sales outstanding plus average sale period minus average payment period. Why? Because the company needs to know how many days they gonna sell its inventory plus collect the money. And the company needs to know how many days they pay its vendors when the payment come due. The total is the days sales outstanding is 18 days and the inventory outstanding is 7 days. The total is 25 days, whereas the average payment period is 12 days. So the difference between the collection and the payment is 13 days. It indicates that the company eventually run out of cash. My suggestion is the company should get revolving credit from its bank in order to ensure cash in need. On the collection side, to reduce the 18 days, I would suggest the company faster collection, say 60 days instead of 90 days in this scenario. And on the inventory outstanding 7 days, I would suggest that the company differentiate its product. And on the production, I suggest that the company should engage its people, its employee in the stack of the company in order to reduce defective products. And on the payment side, I would suggest the company extend the payment, say 90 days instead of the 80 days. To do that, the gap 13 days between the collection and the payment would closer. It means that the company would borrow less money, pay less interest expense, and the bottom line is the company's operating income would increase. Thank you.
Alright, so basically today I'm going to be presenting on the variances for XYZ Whole Distributor, talking about the favorable variances it have, which increase operating income, and unfavorable variances that increase income as well. Starting out with flexible budget variances, the revenue variance of $30,400 is a favorable variance, and the reason for this variance is the increase in the selling price of $7.60 per unit, which would increase the average selling price to $197.60 from the budgeted $100.90. Continuing on, the favorable variable cost variance can be the result of a decrease in the rate of calculating the variable cost from 18 cents towards something lower. Also, another reason for having a decrease in cost can be a decrease in the average purchasing price. The result would then leave us with a decrease of 43 cents per unit. The unfavorable fixed cost variance can be the result of an increase in the management costs, an increase in insurance premium, or an increase in the facility costs that, although they are fixed costs, they shouldn't really fluctuate but in this reason, we did have an unfavorable variance for them as well. Right, so continuing on towards sales volume variances, the reason for a favorable contribution margin variance can be due to selling more units than budgeted. Initially, both units sold revenue have a favorable variance of $500 and $95,000 respectively due to selling more units than initially budgeted. Although variable costs have an unfavorable variance of $19,100, it is partly due to the increase in units that were sold, which would increase variable costs and net to a favorable contribution margin variance of $2,900. And lastly, going to talk about the static budget variance for ZYX Whole Distributor. The difference of the favorable $34,428,000 variance is a result of selling 500 more units than at a higher price at $197.60, rather than the static budget price of $100.90. Based on this level of output, the number of units sold is the cost driver for a favorable revenue variance and a favorable contribution margin variance, which allows us to cover the immaterial unfavorable variance of $200 in fixed costs as well. A lot of these variances do tend to be favorable, the big one being revenue. That seems to be the reason why, although we have some unfavorable ones and more expenses and fixed costs, they're pretty much net together towards a favorable variance of $34,000. Basically, the increase in revenue towards by selling them at a higher price and also selling everything else higher than the static budget and also having a few more costs as well did help ZYX Corporation become far more successful than expected.
In conclusion, these recommendations would help ZYX become more profitable by increasing collections, improving its ratios and its turnovers, and decreasing any uncollectibles. Thank you. Thank you for choosing CAT LLP for any consulting services. We hope you take into account our recommendations and I hope it will help you become a better and stronger company.